Although young, New Zealand is rich with a precious history. A quick look around any city centre shows buildings and statues intended for future generations to admire. Natural waterways or landmarks have created a playground for us Kiwis to interact with and protect. Today, I will be presenting from the Cambridge Museum in the Old Courthouse, a home to many heritage items of Cambridge. These statues and natural habitats are classed as heritage items, and today my key focus will be on how we account for them. I chose to look at the consultation paper, Financial Reporting for Heritage in the Public Sector. So from this, we need to look at what are heritage items. As briefly mentioned before, heritage items can be classed into three different categories. These are physical, natural, or intangible. Physical looks at land bases or objects that are created by earlier inhabitants or a memorial of previous people. Natural looks at natural landmarks created by the environment. And the intangible are generally practices, knowledge, or skills that have been passed down through generations. From an accounting perspective, items need to belong to someone or an entity. How we account for them is currently a reasonably grey area. As with all reporting, we follow the generally accepted accounting practice guidelines. These have rules and regulations that need to be followed to ensure that users of the financial statements can make informed decisions. The grey area with heritage items comes into play when how we record them. By definition, one would assume they should be classed as an asset. However, there are good arguments to suggest that they more represent a liability, and in the following that, there are areas around them that could be expensed. Heritage Items as Assets is a paper conducted by Ruth Green of the University of Waikato, and it looks at the conceptual issues faced with classing heritage items as assets. She recognises that there is issues associated with the classification, but she does not believe that they should be left out altogether. Looking into this, we can see a variety of hiccups that make recognition difficult. And these are: firstly, we can look at different ways heritage items might be valued. From Green's paper, we gather that there is two ways to value heritage assets. Direct consumption. This is value in which the consumption of an item provides immediate utility to the consumer and no one else. And opposing this is non-consumption. Or if we look at the consultation paper that I investigated, they take a view directly from the definition of an asset. Due to this, they do not believe that intangible heritage items can be recorded as an asset. This is because they cannot be controlled by an entity due to the fact that they are owned by the whole community. I think that this is an interesting point, and I would like to bring together an example. Say there is a theatre company that shows traditional Asian dances. Tourists come from all around the world to watch these traditional dances. Effectively, these dancers pull in customers. Without it, sales wouldn't be what they were without the dance. Is this any different to the way in which location, customer service, or reputation pull in customers? Their class is goodwill, and they have a huge impact on the value of a business. Another key area is the actual measured amount on the balance sheet. If the heritage asset is included. It is extremely important that this be material and verifiable, as the measured amount is used against the entity's liabilities. If this was incorrect, it could lead to an uninformed decision being made by potential investors or buyers. According to the conceptual paper, there is five measurement bases that need to be used. These are historical cost, market value, replacement cost, net selling price, and value in use. One area that they don't include is the value based off the cash flows generated from an asset. And there's another local example that I'd quite like to look at, and these are the Rotorua mud pools. These mud pools don't fit into any of the above categories due to their natural nature. However, they provide economic benefit through cash flows from ticket sales to the entity. A value of the mud pools to the entity could be quantified through the cash flows brought in from tourism. Now I'd like to look at heritage items as liabilities. According to the IPSASB standards, they look at heritage-related obligations, and entities that are in control of physical heritage items have a moral obligation to preserve them. Interestingly enough, this obligation represents an outflow of economic benefit from the entity, no different to an entity's obligation to provide maintenance to infrastructure such as roads or to the electricity supply. However, they do go on to say that due to the special nature of the heritage items, they do not give rise to a present obligation that would result in the recognition of a liability. This is a good point, but I certainly don't think that a blanket statement can be placed on all heritage items. And from this, I'd like to look at another example. Say an entity has control of a painting that is mounted in a museum. They have borrowed this painting from a collector, and they charge ticket sales for people to come and view this painting. However, as they have borrowed the painting, they do not physically own it. And the collector asks for it back, and they give him back the painting. However, sales drop in the museum due to the fact that the painting is no longer being displayed. According to the conceptual paper published by IPSASB, to settle a liability, there must be an outflow of economic resources. This outflow is recognised as the decreased ticket sales, and it also recognises the future sacrifice of economic benefit as they are forfeiting sales in the future as they no longer have the painting. Although hard to differentiate between a situation, and this scenario certainly does seem extreme, I think it should be important to recognise somewhat of a middle ground or a case-by-case basis when determining whether a heritage item be recorded as an asset or liability. Following on from this, we look at subsequent expenditure of heritage items. This looks at the measurement of the heritage item once it has been recorded as an asset or liability. Note, the conceptual paper does not recognise heritage items as liabilities, so there are no subsequent measurement for it. As heritage items will require a subsequent expenditure, the argument comes to light as whether this should be capitalised or expensed. This area is reasonably straightforward, and in my view is conclusive with the report published by the IPSASB. They basically state that all repairs should be expensed unless they increase the carrying amount of the relevant asset and it is probable that they confer future economic benefit that can be measured reliably. Then they should be capitalised. An interesting area around heritage items is depreciation. Some heritage items deteriorate over time and therefore can be depreciated. However, some do not. These include jewellery and land. Many also have a very difficult useful life to determine, therefore the depreciable amount applicable to each year is hard to calculate. According to the conceptual paper, depreciation is measured on a case-by-case basis, dependent on the asset and its details determines whether depreciation can be applied. We can look at two different examples to clarify this point. The crown jewels in the above picture have a very long useful life, and although parts of them might depreciate, the body of the jewels will appreciate. Measuring the appreciation or depreciation of these jewels is very hard and will not follow any set guidelines. The stone fence in the below picture, however, would be easy to measure due to the consistent nature of its depreciation. In conclusion, I looked into the conceptual paper Financial Reporting for Heritage in the Public Sector, published by the International Public Sector Accounting and Standards Board. It delved into many areas relating to heritage items, but I chose to focus on 3 key areas. These included recognition as an asset, recognition as a liability, and subsequent measure for the items. I noted 3 key areas relating to assets, that is, physical, natural, and intangible. And I also looked into certain situations that could push back against the IPSASB statements. Although some situations were extreme, I thought it was necessary to bring them up, as in reality, extreme situations often can occur. My key area of concern is the lack of recognising a case-by-case basis for heritage items. For the subsequent measurement, once a heritage item has been classified, they are happy to offer a different measurement requirements dependent on the situations. I think that they should look to incorporate this into their initial recognition as well. Thank you.